Good morning, everyone. It's that time of the quarter where Greg and I get to sit down and discuss, which is now another important Fed meeting. First of all, hello, everyone. My name is Michael Naidrich. I am the co-CEO of AmeriVet Securities, and I am always very warm-hearted to be joined by my partner, CFA, everything's Fed, liquidity and rates, Gregory Faranello. Hey, Greg, how are you, bud?
Good morning, Michael.
So here we go, Greg. A lot going on. I think there's a lot of talk about a potential pause. The CPI number came out today. So if you maybe can give us a few minutes on framing this meeting out for us, I think that'd be helpful for our clients.
Sure, I'd love to. Thank you for that. It's great to be back with you. So hot off the press, CPI came in largely a little bit better than expected on the overall number. Obviously, we've seen energy prices come down. The core number is still a little sticky, but that one component that the Fed is looking very closely at, which is services ex housing, 0.2 month over month. So back to really pre-pandemic levels. With that, you look at the intermeeting Fed speak, a lot of it out there all over the map. We go back to May 19th, Chair Powell saying the Fed is in a position to really sort of take a pause. They're calling it a skip, and then validated by soon-to-be Vice Chair Jefferson, who was nominated by President Biden to fill the seat of Lyle Brainerd, which is really the right-hand person to Powell in terms of Fed policy, reiterating that sentiment as we headed into the blackout period. With that, we don't think the Fed is going to take their foot off the gas here potentially. So hawkish pause, I think, is how the market is categorizing this. And if you look at market pricing right now for tomorrow, largely priced, and we're snugging in with CPI, largely priced for that pause or skip. We do have some probability of another rate hike priced in for July. And the way we see it for tomorrow, summary of economic projections, we think the Fed will take that terminal rate, which is at 5.1 in March. We think they'll include another rate increase, so call it 5.3 to 5.4 to show the market that they're probably more inclined to go higher here than cut rates. And we think certainly Powell and his presser is going to reinforce the notion that the Fed is not necessarily done here, that the next move could very well be a hike, just like we saw from the Bank of Canada recently.
Yeah, I keep hearing you use the term hawkish pause, which is an interesting term. So let's just take a step back, which you and I always like to do. And, you and I were sitting here and we were talking in April, and we were talking to a lot of clients and, Silicon Valley Bank and run on the banks. And it was pretty tenuous there for a little bit. And it really caused the debt markets to freeze up there for basically 3 weeks, I think, give or take. But we've seen a really nice bounce back in the debt markets. It's very open. It's very busy. I think May was, record month or close to a record month and outlasted all expectations. And I think we sit here in June with a couple of important holidays for our country. And, I think we're still doing okay here early June. So if you could touch on that for a second, I'm most appreciative.
Sure. So very good points. I think the big thing that the Fed has tried to do here is separate some of the issues that we're seeing on the banking side from the fight against inflation. So what do I mean by that? So, special tools that the Fed implemented during the pandemic that they did in 2008 here with the bank lending program to try and fill the gap with the deposit flows that we're seeing. They put that on their balance sheet. They actually expanded their balance sheet when they put that on their balance sheet, the lending that they did to the banks. Obviously, the loans are an asset to the Fed's balance sheet. And at the same time, they're saying, look, we could fight two battles at the same time. We could fight the inflation battle with regard to raising interest rates, that blunt tool that we're seeing, and it has been very blunt for the last year and a half. And at the same time, some of these peripheral issues, we think we can solve the financial stability issues with some of these different programs. So to date, it's really hard to argue that they haven't been relatively successful. We don't know how the bank earnings are going to go as they replace 0% deposits with more costly funding. But the reality is, when you look at markets across the board, and we follow the Treasury market very closely, lower volatility is good for markets. Markets in general, risk assets like lower volatility, in particular the Treasury market. So if you look at the MOVE index, if you look at the CDX index, which is credit, and certainly if you look at the VIX now, which is close to all-time lows, risk assets, to your point, have enjoyed a very, very good pocket of time here. And I think it's enjoyed a very good pocket of time because volatility in general has come down relative to that March period.
Yeah, it's been an incredible ride for equities this year. And it's, again, one of these, what do they say, hated bull markets, right? It kind of feels that way. And there's some other choices, right? Because, you can get some yield away from markets, which we haven't seen in years. So, here we are, Greg, halfway through the year again, which I don't even know how that happens. Here we are. Let's take a look at the second half. There's a lot going on. There's, like you were saying earlier, a pause, maybe a pause and a hike. Is it even possible that we see a cut? There's a lot of different opinions out there. I think it'd be helpful to our audience and our clients if you can frame what you're seeing here, maybe the second half of the year.
Sure. So short term, I would say the wall of worry, Mike, you look at the debt ceiling, we got past that. I think everyone knew in some way, shape or form, we would get past it, but we did get past it with the timeline. We didn't kick the can, down the road for a couple of months. I mean, we've got a couple of years of window of time here. We've been writing to clients and I kind of stick to it. We came into 2023 with the notion, and if you look back historically, risk assets perform very well when inflation is stable and inflation is predictable. And if you go back to the period even after 2008, markets went up in a fairly orderly fashion. Rates were close to zero for a long period of time. The Fed obviously tried to lift off unsuccessfully, but inflation was very, very stable and risk assets enjoy that. So our view for this year, and I would say it still remains the same way for the second half of the year. And we're seeing it today and we've seen it recently. If inflation does still continue to come down, we think risk assets will perform well, even in the second half of the year. Now, having said that, you look at equities, obviously we've come a long way. There is certainly room for caution here, but capital markets, as we know, primary markets are wide open. Secondary markets are certainly trading. And when I look to the second half of the year, yield is in vogue here for sure. The short end of the yield curve, both in treasuries, credit, you look at mortgages, these rates are still very attractive, but I do think reinvestment risk is pretty high here. And what I mean by that is, although we've priced out the notion of these rate cuts and we pushed back against rate cuts in 2023, there are certain parts of the economy, we look at leading indicators that are showing this economy in a state of deceleration. The one crutch has been obviously the employment market, which has been strong, which we're thankful of in general, but from the Fed's quest to get inflation even further lower, certainly the employment market is front and center. So what does the Fed do in the second half of the year? I mean, look, we have to err on the side of caution here. We would say that if we had to err on the side of rate cuts versus further rate hikes, everything we see given core inflation, it's probably likely that maybe the Fed nudges a little bit higher here. But with that, Mike, the yield curve is still very inverted. So when I look further out the curve, if I look at 10-year yields, real yields, if I look at nominal yields around 375 to 380, in and around 4% to 4.25, the accounts that we talk to are still looking to add duration further out the curve opportunistically, picking their spots. So the moral of the story is the Fed goes higher second half, 5.5, even if they go to 6%, we think that curve inversion maintains itself, may even, in fact, deepen a little bit. So you could get a 550 or 575 Fed funds rate, and you could get a 4.25, 450 10-year yield. But we think accounts would definitely look opportunistically at adding duration further out the curve with the notion that the higher the Fed goes, at some point, these rates are coming back down. And my view is the higher they go, the quicker and bigger they come down over time. It may not be 2023, but certainly 2024 is in play.
Yeah, that's really interesting. And, I think that, like we said, the debt capital markets has been wide open. It'll be interesting to see when the equity capital markets come back. In my opinion, I think, stabilization of rates will be helpful in that. And I think also when people maybe have a little more reality evaluations and become the market, I think that will set it up okay. Well, look, Greg, this has been fantastic as always. And, we enjoy this. I can't believe 4 years has passed. You know how much I personally enjoy it. And I think it's very helpful to our clients. And I know that you've been on a ton of calls lately with us, and our treasury teams are certainly appreciative of that. So if anyone would like to, hear from Greg, he's going to do what he always does. He's going to watch the Fed. He's going to watch the minutes. He's going to watch the presser, and he's going to read into it and give you his, highly educated, independent decision always. So we wish everyone a great holiday this Monday and a couple of weeks from now, celebrating our country. Thank you very much, and have a great day, everyone.